In 2019, one company was valued at $47 billion. It wasn't just growing, it was everywhere, expanding globally, dominating headlines, and attracting billions from investors who believed they were watching the future unfold. At the center of it all was its founder, often compared to visionaries like Steve Jobs and Elon Musk. Everything about it felt unstoppable. And that's what made what happened next so shocking. Because this wasn't a slow decline. It happened fast. Within weeks, everything changed. The company was fighting to survive. Its CEO was forced out, and its $47 billion valuation collapsed. So how does something that big fall apart that fast? This is the story of WeWork and how it all came undone. Every major shift in business usually begins with something simple, a frustration people have learned to live with, until someone decides it no longer makes sense. In this case, it was the way people worked. For decades, offices followed the same rigid formula: long leases, fixed spaces, and commitments that rarely matched how businesses actually operated. Companies were expected to lock themselves into years of rent, regardless of whether they needed that space long-term. For startups, freelancers, and small teams, that model felt increasingly outdated, expensive, inflexible, and disconnected from a world that was becoming more dynamic by the day. That's where Adam Neumann saw an opportunity. Not just to improve office spaces, but to rethink the entire concept of what a workplace could be. What if office space worked more like a service, flexible, on-demand, and adaptable? What if businesses only paid for what they actually needed? And more importantly, what if offices weren't just functional environments, but places people genuinely wanted to spend time in? That idea became the foundation of WeWork. Instead of traditional offices, WeWork introduced shared workspaces designed with intention. Open layouts replaced closed rooms. Natural light, modern furniture, and thoughtfully designed common areas created an atmosphere that felt less like work and more like a community. But what truly set it apart wasn't just the design, it was the feeling. Walking into a WeWork space didn't feel like entering an office. It felt like stepping into a space filled with energy, movement, and possibility. People weren't just renting desks, they were buying into an experience. And that emotional shift made all the difference. Because once work started to feel different, the idea didn't just grow, it spread. WeWork didn't present itself as just another real estate company. Doing that would have limited how investors saw its potential. Instead, it told a much bigger story, one that went beyond office space and into the future of how people work, connect, and collaborate. It was framed as a company that wasn't just providing desks, but reshaping the way humans interact in a modern economy. That narrative mattered, because in the startup world, perception can be just as powerful as reality. Investors aren't only funding what a company is today, they're betting on what it could become tomorrow. And that belief attracted serious capital. Backed by firms like SoftBank, billions of dollars began flowing into WeWork. With that level of funding, growth didn't just continue, it accelerated. Expansion became more aggressive, with new locations opening rapidly across major cities. Entire markets were entered in quick succession, often faster than the business model could fully support. For a time, it seemed to work. Growth created momentum, and that momentum reinforced belief. As long as the company kept expanding, the story held together. Valuations climbed steadily, from $10 billion to $20 billion, then $30 billion. Each milestone strengthening the perception that this was something extraordinary. Eventually, that momentum pushed WeWork to a staggering $47 billion valuation. At that point, it wasn't just a company anymore. It had become a symbol of ambition, possibility, and the kind of scale a modern startup could reach. But while everyone was focused on that growth, very few were looking closely at what was underneath it.
At its core, WeWork was built on a model that seemed simple, but carried a hidden weakness. The company signed long-term leases on buildings, often committing to years of fixed payments. It then rented out those same spaces on short-term agreements, offering flexibility to its customers. On the surface, this looked like a smart approach, one that matched the changing needs of modern businesses. But beneath that simplicity was a critical mismatch. Long-term costs are fixed. They don't change regardless of market conditions. Short-term income, on the other hand, is unpredictable. It depends entirely on demand, occupancy, and the willingness of customers to stay. As long as demand remained high, the model worked. Buildings stayed full, revenue flowed in, and the imbalance remained hidden. But the moment demand slowed, even slightly, the system became exposed. Revenue could drop quickly, while expenses stayed exactly the same. That kind of imbalance doesn't just create pressure, it compounds risk over time. Instead of slowing down to address this vulnerability, WeWork continued to expand. New leases were signed, more buildings were added, and the company pushed further into new markets. Growth became the focus, and for a while, it masked the underlying problem. From the outside, everything still looked strong. Locations were filling up, the brand was gaining attention, and the narrative of success remained intact. But behind the scenes, the numbers were telling a different story. WeWork wasn't just unprofitable, it was losing billions of dollars each year. And despite those losses, the expansion didn't stop. Which raises an important question. If the risks were there, why did no one slow things down? The answer, in many ways, comes back to one person, Adam Neumann. He wasn't just running WeWork, he was shaping how the world saw it. His presence defined the company's identity, not just internally, but in the eyes of investors, employees, and the public. Neumann's leadership style was built on confidence, charisma, and an unwavering belief in a much bigger vision. He didn't focus on limitations or short-term concerns. Instead, he spoke about transformation, about redefining how people experience work, and creating something that extended far beyond traditional business models. That kind of vision is powerful. It creates momentum, not just within a company, but around it. When people believe in a leader, they often begin to believe in the future that leader describes. And in WeWork's case, that belief became one of its strongest driving forces. Investors placed their trust in him, backing the company with billions of dollars. Employees followed his direction, motivated by the idea that they were building something meaningful and groundbreaking. And as long as that belief held, the company continued moving forward, growing faster and reaching higher valuations. But belief, no matter how strong, doesn't exist in isolation. Over time, it begins to encounter reality. And when it does, it has to withstand scrutiny. Because eventually, every story, no matter how compelling, reaches a point where it has to prove itself. In 2019, WeWork began preparing to go public, a moment that was expected to validate everything the company had built. For years, its rapid growth and soaring valuation had been driven by belief in a powerful narrative. Now, the IPO was supposed to confirm that belief with hard evidence. This was where the story would meet reality. But going public introduces a level of scrutiny that private companies don't always face. It requires transparency, detailed disclosures about financial performance, business structure, and long-term viability. For the first time, WeWork had to present its numbers to the broader public, not just to a select group of investors. And when those details became visible, the reaction was immediate. The company's losses were far larger than many had expected, and its path to profitability remained unclear. At the same time, aspects of its corporate structure raised additional questions.
making it harder for investors to fully understand how the business was being managed. As a result, the narrative that had once seemed so compelling began to lose its clarity. What had been framed as a high-growth, transformative company now appeared more uncertain when examined closely. Investors, who had previously relied on vision and momentum, started asking more direct and detailed questions. They were no longer satisfied with broad explanations or ambitious projections. They wanted concrete answers supported by numbers that made sense. When those answers didn't fully resolve their concerns, confidence began to shift. And once that confidence started to drop, it did so quickly.
What followed wasn't gradual. It unfolded with surprising speed. After the concerns raised during the IPO process, WeWork was forced to withdraw its public offering. What had been positioned as a defining moment quickly turned into a setback. And with that shift, the company's valuation began to fall sharply. The pressure that had been building behind the scenes now became impossible to ignore. Investors who had once supported the company's rapid expansion started to step back, reassessing both the risks and the assumptions that had driven its rise. Confidence, which had fueled much of WeWork's growth, began to weaken. And once that change started, it moved quickly. At the center of it all was Adam Neumann. His leadership had shaped the company's identity and played a major role in attracting both attention and capital. But as scrutiny increased, so did the calls for change. Eventually, Neumann stepped down as CEO. It was a turning point. The figure who had defined the company was no longer leading it, and without that central presence, the structure that held everything together began to show its fragility. The $47 billion valuation that once symbolized WeWork's potential didn't decline slowly. It collapsed, marking one of the most dramatic reversals in recent startup history. In the aftermath of the collapse, WeWork was forced to undergo a fundamental shift. The focus was no longer on rapid expansion or ambitious growth targets, but on something far more urgent: survival. The company began implementing significant changes to stabilize its operations. Costs were reduced across the board, and a large number of employees were laid off as part of broader restructuring efforts. Expansion plans that once drove the company's momentum were scaled back dramatically, reflecting a new and more cautious approach. At the same time, WeWork became increasingly dependent on support from SoftBank, whose financial backing played a critical role in keeping the business operational during this period of uncertainty. As these changes took place, the narrative surrounding the company shifted. What had once been a story defined by rapid growth and bold ambition was now centered on recovery, stability, and the challenge of rebuilding trust. The company that once symbolized the future of work was now focused on finding a way forward after a very public fall. But this story isn't just about WeWork. It reflects something much broader within the startup ecosystem. In many high-growth companies, there's often a gap between perception and reality. On the surface, everything appears strong: rapid expansion, rising valuations, and a compelling narrative that attracts attention and investment. But beneath that surface, the underlying fundamentals don't always keep pace with the story being told. For a time, that gap can remain hidden. As long as growth continues and confidence stays high, the narrative holds together, reinforcing itself with each new milestone. But that balance is fragile. Eventually, reality begins to catch up. And when it does, the difference between what a company appears to be and what it actually is becomes much harder to ignore. The story of WeWork highlights a pattern that appears again and again in the world of startups. Hype can attract attention and generate momentum, but on its own, it cannot sustain a business. Growth can be impressive and even necessary, but without discipline and a solid foundation, it often introduces more risk than stability. At the same time, vision plays a powerful role. It can inspire people, attract talent,
and convince investors to believe in something larger than what currently exists. But without structure and accountability, even the strongest vision can become fragile under pressure. And when it comes to investors, belief may drive early decisions, but over time, that belief is tested. In the end, what matters most are the numbers, the fundamentals, and whether the business can truly support the story it tells. So when you look at WeWork today, the question isn't just what went wrong, it's something deeper. Was it ever truly worth $47 billion? Or was that valuation simply the result of a story that people wanted to believe? A narrative that, for a time, felt more convincing than the reality behind it. What do you think? Was WeWork a brilliant idea that eventually lost control? Or was it a flawed model from the very beginning? Share your thoughts in the comments. Because sometimes, the most valuable companies in the world aren't built purely on fundamentals. They're built on belief. And when that belief fades, everything built on top of it can begin to fall apart.